Stock and CFD trading involves risk, and the better you understand the risks that affect you as a trader, the better you can protect yourself from those risks. As a trader, you should be aware of at least the following 6 types of risk you face: systematic or market risk, unsystematic risk, credit and default risk, exchange rate risk, interest rate risk, and political risk. Systematic risk is the risk you face because you are operating within a system, the stock and CFD markets. While traders are able to take steps to hedge against certain types of risk, there is no way to hedge against systematic risk. If you want to participate in the markets, you have to be willing to accept the risks that come with being a part of the market. Unsystematic risk is the risk you face by dealing with a particular stock or CFD. When you trade stocks and CFDs on an individual company, you are aligning yourself with the fate of that company. If you have bought the stock or CFD and the company performs well, your investment in that company should also perform well. If you have bought the stock or CFD and the company performs poorly, your investment in that company should also perform poorly. Credit and default risk is the risk you face that a company you have stock in or own CFDs on may default on its debts or be viewed as a credit risk in the market. Although it doesn't happen too often, companies can become insolvent and stop paying on the debts they owe, whether they be debts owed to banks or debts owed to holders of company bonds. Exchange rate risk is the risk investors face when they buy and hold investments in a currency other than their native currency. Just as stock prices fluctuate up and down, currency values fluctuate up and down. If the currency in which the investment is held gains value compared to the investor's native currency, the investment will be worth more to the investor. However, if the currency in which the investment is held loses value compared to the investor's native currency, the investment will be worth less to the investor. Exchange rate risk can even offset any gains the investment may have made on its own. Interest rate risk is the risk that interest rates within an economy may change and affect stock values. Central banks like the U.S. Federal Reserve, the Bank of England, and the European Central Bank have an incredible impact on global and local economies when they announce their interest rate decisions. Generally, when central banks increase interest rates, it becomes more difficult for companies to borrow money to grow and expand. This in turn negatively affects the future outlooks for the company's growth and tends to pull down the company's stock price. Political risk is the risk you face that the political environment in the country or countries where a company does business may become unfavorable for business growth and expansion. On the extreme end of the scale, political risk can take the shape of a company being nationalized by a government, causing stockholders to lose much of the value they had in their shares.